Hello, everyone. Welcome to the Small Cap Insights podcast powered by Darrow Associates. We are a leading full service investor relations firm focused primarily on the micro and small cap space. My name is Jack Greenberg, and I'll be your host for today's episode. I'm excited to be joined by Tobias Carlisle, Principal and Chief Investment Officer of the Acquirers Funds, and an accomplished author in the value investing space. Tobias, thanks for joining us.
Thanks for the kind intro, Jack. Nice to be here.
Yeah, of course. So let's just get started with a little bit of background. Can you tell me a little bit about yourself and your journey to Acquirers Funds?
Yeah, I was a former corporate advisory attorney, dealing in mergers and acquisitions and other corporate activities. I've worked in as general counsel of a public company. I've worked in an activist fund, and now I run two ETFs in uh, Los Angeles that focus on US domestic deep value equities, small cap industrial type businesses.
Got it. So yeah, the mid cap deep value ticker is ZIG for our listeners, and the small cap is deep DEEP. So I'd like to focus on that micro and small cap fund a little bit today. How do you describe the core investment philosophy for deep?
So it's deep value, um, which is looking for. So we did some research published in a book in 2012 called Quantitative Value that looked at every bit of industry and academic research we could find on fundamental value investments. So we looked at credit, business quality, valuation, and then we look at earnings manipulation, fraud, other aspects like that. And so we're looking to build a portfolio of companies that are cheap on an acquirer's multiple basis, which is my name for operating earnings compared to enterprise value. And enterprise value is market cap plus debt, minority interests, preferred stock, and so on. So it's looking at an acquirer buying the business in its totality, buying the company in its totality, and then we look at if it's cheap on that ratio, what is management doing with the cash flows? Are they rebuying stock? Are they paying down debt? Because those qualities tend to be found in businesses that are a little bit more robust. They've got free cash flow through the full cycle. So we're trying to buy businesses at the trough of their cycle where management is doing the right thing, buying back stock. And the idea is that over time, paying lower prices for reasonably robust businesses tends to outperform. Um, and so we put that into two ETFs. ZIG is the largest 25% of all names, but that tends to be clustered right down towards the small cap end of the market. And then Deep is the smallest 75%. And that tends to be really small and micro cap stocks that fall off the bottom of the Morningstar style box. So they sit outside the usual range. And they're very volatile little businesses. So they suffer when the economy is softer, and they do very well when the economy is doing better.
And so looking at that deep portfolio, it appears that kind of three industries make up a really significant portion of that portfolio. Why do you think kind of the consumer, industrial, and financial industries tend to present those deep value opportunities more so than other industries?
I think that it tends to be a little bit dependent on where we are in the cycle. So I think that there was an enormous amount of stimulus from the COVID pandemic, and that pulled forward a lot of consumption through 2021 and 2022. And since 22, I think the consumer has been particularly weak, and so has the small business. Uh, and most businesses have been pretty weak. If you look at the S&P 500 earnings on a per share basis, they're down since 21. S&P 400, which is the mid cap index, those are basically flat since 2021. And the S&P 600, which is the profitable small cap index, those earnings are down since end of 21. And the multiples as a result have sort of all followed those. So the S&P 600 multiples as a relative to the S&P 500 are roughly where they were in the late 1990s, which is about as undervalued as they get. Um, And then in that sort of pool, so I think small cap is particularly undervalued. I think if you look at the value as a component of that, this has been a little cycle that has favored the more speculative names. So many of the names, so if you compare the Russell 2000, which doesn't have the profitability requirement the S&P 600 does have, that has outperformed, even though the earnings are much weaker because they just don't have that profitability filter. So it's been a market that's favored size and it's sort of ignored profitability. So the profitable small caps are really undervalued. And then in that, it's things that haven't participated really this in this sort of AI capex run, and some of the associated like nuclear and uh, the quantum computing and all of that stuff. Really, it's there's no business, there's no technology there yet. There's sort of just a plan to build something. But if I look into consumer cyclicals, because the consumer's been weak, anything that's touching the consumer has really been hit hard through that period in terms of earnings, and the multiples are down too. So I think that the biggest concentrations tend to be in energy, which is as cheap as it's been since 2020 when we printed negative oil, and then 2000 when we had a similar kind of dot-com blow off top. Consumer cyclical, so that's anything that touches the consumer. And then financials too. I think that that's also part of the same sort of just general weakness. I think people are struggling to pay back some of their credit cards and auto loans, and I think that younger folks who've caught the requirement to start repaying student loans, all of that has made consumer fairly weak. When there's no household formation too, that shows up in dishwashers aren't purchased, refrigerators aren't purchased. So all of those sort of businesses that sell into that household formation, and that's because there are very few houses being sold because there's a big increase in what was being in 2021. Mortgage payments in 2021 are about half what they are now for the same house, which is a combination of interest rates and prices. And so that has to correct at some point. Interest rates can fix part of that problem, but prices probably in houses have to come down. So I think all of that has meant that there's pretty broad-based weakness. It is throughout the S&P 500 as well, even though the S&P 500 index is covered over a little bit because the very biggest names in that index, which is the Magnificent Seven, have been very strong, and they're the beneficiaries of this capex spending and sort of excitement around it. So they're all trading at very high multiples, which I think is a scenario similar to the late 1990s. So I think it's a good time to be a small cap value investor, even though the historical run to get to this point has been pretty ugly.
Yeah, it's interesting you say that. I've had a lot of people on the podcast that share that same kind of sentiment of, we're due for a small cap rebound. But you mentioned that you screen companies for kind of signs of fraud and earnings manipulations. What are some of the things that you see that immediately raise red flags for you on that front?
There are lots of statistical tests. So we base it on a lot of the research that's been done, and we discussed some of it in Quantitative Value, the book that came out in 2012. But basically, you can look at earnings quality, which is just our cash flows generally matching earnings over time. And you can examine that from a different perspective, looking at accruals. So when accruals grow, that means that that's an asset blowing up because there's some mismatch between earnings and cash flows. We also look at just statistical measures like Olson's O or Piotrowski's Z-score. We do little variations of these fairly standard tests, and then those things tend to turn up weakness and difficulty in making payments and weakening businesses. And it's often those weakening businesses that have an association with fraud. People don't tend to commit fraud when the business is going very well. That's not to say that people don't tend to commit fraud when the stock price is doing very well, because that's a different question. We're really talking about the fundamentals of the business. And so if you look at statistical triggers for all of these things. You tend to find clusters of these little metrics in certain businesses, and then we just simply ignore those businesses and we don't consider them in the rest of the process. So that's really the first step, just to make sure that there's nothing that has those qualities. That's not to say that they can't develop in businesses that we own over time. And so we keep on running those measures all the time, but that's what we're looking for. It's basically statistical measures. I think if you find something that's undervalued and buying back stock, that's a very good sign because it tends to be businesses that actually have the cash flow coming in. They have the cash on the balance sheet and they have a view to further cash flow down the road that do the really good buybacks when they're undervalued. Buybacks when stocks are expensive are no good. And when a stock is cheap and there are no buybacks going on, that says to me that there might also be a little bit of weakness in the business that might extend beyond, kind of what you're currently seeing. So that's what we're looking for, statistical measures and then sort of management behavior as well.
Got it. So when considering a potential investment, are buybacks and kind of management being aligned with shareholders one of the most important things that you tend to look at?
It is very important. It would be a question when a company is undervalued and it looks like they have the cash there to do the buyback or the free cash flow to do the buyback. If they're not doing the buyback, that would be a question why that's not going on. It's not to say that wouldn't exclude a business necessarily because they can be paying down debt. There are other things that they can do with those cash flows. It's just that's a really good opportunity if you're convinced that your stock is undervalued, and as an external pair of eyes looking at the business, I think it's undervalued. Management, I would hope, would be doing the same thing in that scenario. So it tells you that they're thinking about shareholders. They've got the free cash flow. It's lots of good signs when they actually do the buybacks. If they don't do the buybacks, it's not necessarily a totally bad thing, but it's a very good sign if they are doing the buybacks.
Yeah. And kind of just to wrap it up here, if you look down the horizon, 5 to 10 years, earlier you mentioned kind of AI and the energy needs that has to go along with that. What are you excited about looking down the line a little bit?
I think that there have been various cycles. You can look back 100 years because the French data, Ken French's data goes all the way back to 1926.
Mhm.
And so we're like literally 100 years of that data. And you can see that it's been small caps have outperformed large caps. And depending on how you measure it, largest decile, which is the largest 10% versus the smallest decile, smallest 10%, it's been about 1.7% a year, even to this point where there's been quite a lot of large cap outperformance. And if you look at the most expensive to like an S&P 500 type, so these are large caps versus the very largest, it's been about 0.8% a year. So there's a big advantage to being a small cap investor. And the reason is that earnings tend to grow faster for small caps. Large caps tend to be more stable. Small caps tend to grow earnings faster, but they're more volatile. So they're very economically sensitive. If you go through a period where there's lots of tariffs and rising rates, you would expect to see some effect in the business and a lower multiple. If we look back over the 100 years, there have been 6 of these periods of extended large cap dominance over small caps. The longest one that we have in the data is 1945 to 1961, which is about 15 years. There have been 3 that have been longer than 10 years, and it was that 45 to 61, the dot-com boom, which ran from the mid-early 90s, and the current one, which begins in 2015. Those go on until they stop. I don't want to be the guy to predict when a very long cycle like that starting in 2015 ends, but we're 10 years in, so it's getting very long in the tooth. It's the second longest in the data. When those things reverse, small caps value massively outperform for extended periods of time, 5 or 10 years. So I don't know when that happens, but I think we're primed for a very good period of outperformance. And I would think that over 5 or 10 years, that's getting highly likely that would happen, even though it's hard to imagine in a market where so much money is flowing towards the big end of town and they're reinvesting at a very high rate. It's happened before in the late 1990s. I think it was a very similar scenario. And then we had 10 or 15 years from 2000 to 2010 or 2015, where there was very large small cap and value outperformance. So I think that cycle is coming, and that's what I'm excited for.
I agree. I hope that's the case. But Tobias, thank you very much for coming on the podcast and joining us. What's kind of the best way for listeners to learn a little bit more about you and access your books?
Acquirersfunds.com has links to many of the books. I'm in Amazon. Just search my name in Amazon, or I'm on Twitter at Greenback, which is a funny spelling, Greenbackd. And I have a website, acquirersmultiple.com, where you can sort of see screens of these stocks. But thanks so much for having me, Jack.
Yeah, of
Appreciate it.
course. I'll include all links in the description. But thank you all for tuning in to another episode, and thanks again, Tobias.
Pleasure.